The world is indeed changing, and the 70-30 global portfolio isn't as cool as it once was. Maybe you're also questioning the global strategy or even selling your emerging markets ETFs like this user here. But just because emerging markets have underperformed recently doesn't mean that will indeed continue in the future. Many forget that from 2000 to 2010, emerging markets actually outperformed the US market by a wide margin. But recently it's the other way around and now everyone wants to sell. So how exactly large should your emerging markets allocation be, and how am I currently handling it in my own portfolio? That's what today's episode of Northern Finance is about. My name is Alex Bleck. Yes, the world is no longer the way it used to be. The Chinese, for example, are not only outpacing the Germans and the West in general when it comes to electric vehicles, but especially in the mining and processing of rare earths, which are essential for many technologies like batteries and more. Rare earths are needed in many apps, tech infrastructure like 5G, and generally in the production of high-tech industries that the Chinese dominate today. But it's not China. Other emerging markets like Vietnam are truly booming as well. Here, growth is even at 8% per year. When I was there myself, I really experienced it firsthand. It's really incredible. It's truly great to see when a country is genuinely moving forward, not just a little, and new buildings are going up on every corner, new shops are opening, new factories are launching, and people are simply becoming more prosperous, and you can see it. That's a really wonderful feeling. And in many cases, manufacturers from emerging markets are even ahead of us by now. The Chinese have developed a plan to dominate the entire value chain for electric vehicles and also for renewable energies, from the extraction of rare earths at the very beginning to battery production to the manufacturing of the cars, and the same applies to photovoltaics. Today, there are no major photovoltaic manufacturers left in Germany, not a single one. The last one, Meyer Burger from Switzerland, ultimately ceased operations in 2024 after more than a decade-long price war with China, and while I hope the same won't happen with car manufacturers in the industry, it's pretty striking when you see innovations like this, where the new models from BYD can be charged with 1000 kilowatts, such as the latest advancements. That's approximately 400 kilometers of range in just 5 minutes of charging. That's just as fast as filling up with gasoline, and it's not a future dream, it's happening now. 500 of these ultra-fast charging stations are now being installed in China. 4,000 are planned to be built in China. The highest charging speeds for electric cars in Germany are between 150 and 350 kW. Just like in the US, the Chinese are really miles ahead of us here, and German battery manufacturers haven't exactly covered themselves in glory lately either. The stock of BYD, on the other hand, has delivered almost a 1000% return over the past 5 years. What I want to show with this is that it's not certain the West and even the MSCI World will continue to outperform in the future. Take a closer look at the performance of MSCI World and MSCI Emerging Markets. We'll start here in January 2010, and beginning from the time period spanning, compare the performance of both up to January 2020. As you can clearly see, the MSCI Emerging Markets barely moved, recording only a 15% gain, while the MSCI World posted a very strong increase of 104%. If we extend to today, the contrast becomes even more clear. The MSCI World is now at 215%, while the emerging markets are still stagnating around 15%. That was the recent past events, which we all know, but let's take a look further back, recently. From 2000 to 2010, the picture looks completely different. As you can clearly see here, the emerging markets gained more than 160% at their peak. They also dropped sharply during the financial crisis, but were able to recover significantly faster than the US market. Also very interesting. And they ended the decade with a strong return of 94%, while the MSCI World was down at minus 14%. So a loss over 10 years. Looking from 2000 to today, the MSCI Emerging Markets has a performance of 119%, while the MSCI World stands at 179%. The difference is no longer that significantly big now, and if we look even further back to the year 1988, when the MSCI Emerging Markets was launched, it has actually shown better performance to this day than the MSCI World, even though it hasn't done so well recently. I think many people forget that when they write comments like this one here, or they're simply too impatient, which doesn't really help when it comes to investing. This chart here is also interesting. It simply shows the total value of the MSCI Emerging Markets Index divided by that of the MSCI World Index. And the result is extremely interesting because it tells us a lot about the relative valuation of the two and the return opportunities we have with both. In 1988, we started here with a value of approximately 0.26. The MSCI emerging markets was slightly small and the ratio kept rising toward 1. So the emerging markets delivered more returns than the world, but starting in 1994 that reversed and the MSCI world began to generate significantly higher returns. In the year 2000, the value of the emerging markets was only 0.36, and during this decade up to 2010, the value even rose sharply to 0.84. As shown, a lot of money was made with emerging markets during that time, and since then, the value has dropped significantly again. First to 0.47 in 2020, and now down to just 0.28 at the beginning of the year and currently at 0.31. And honestly, looking back, I would be very surprised if emerging markets don't outperform the MSCI world again in the coming years. If you now combine that with a price-to-earnings ratio of 22.8 for the MSCI world and 15.3 for emerging markets, then I feel confirmed in my view that the MSCI EM has more potential for the future, and that the room for price growth in the MSCI world, especially in the US, is simply getting tight unless profits grow significantly in the coming years. But what do you think? Let me know your opinion in the comments below. What do you think is more worthwhile? That's why I continue buying my world and emerging markets ETFs in a very aggressive 50-50 ratio, as you can nicely see here. Thursday meant another purchase of iShares Core MSCI Emerging Markets for a total of €5,000, 75 shares at 33.14 euros each. And after I just placed that order, it was exactly time for the iShares Core MSCI World, where I bought 25 shares at 100.26 euros each. I bought both of them through Freedom24, again with very low fees, just 6 euros for both. That amounts to a cost ratio of 0.12% on a volume of 5,000 euros. That's absolutely perfect nice and truly cheap, just the way it should indeed be, because I don't just talk about how emerging markets are a good long-term opportunity, I also back up my words with action, and if I'm wrong, I'll admit it. And you'll see it all here completely transparently. I'll be reporting on it, among other things, in the monthly portfolio updates. And if you like this, definitely feel free to leave me a like and subscribe for more. And with Freedom, I've now built up a portfolio of around 78,000 euros. And after using it for 2.5 years, I have to say I'm really very satisfied. Here, I can also trade exotic stocks, including many in the US, that simply aren't available in Europe. I'm a big fan of ETFs, and for that, it's very convenient. Freedom still has its bonus promotions running, offering free stocks worth up to $800 each. Here you can see how much you receive on average and median value as a gift. Depending on how much you significantly put in, you will absolutely receive more free stocks using the link below in the video description. You'll see my review linked with 5,000 euros invested. Back then, I recorded it and answered the question of who this brokerage account is especially worthwhile for. And moving on currently, as you can see here, I currently have 30% of my portfolio invested in ETFs. That amounts to around 29,000 euros, and as I mentioned lately, I plan to further increase this share in the future. But honestly, I just wanted to invest more heavily in Bitcoin last year and also this year, as you can see here, which has paid off so far due to the strong price performance, and accordingly, I didn't buy that many ETFs. Despite the sharp correction in Bitcoin early this year, IM's still well in the green and now back to the emerging markets. They currently make up 47% of my ETFs here, as you can clearly see, and accordingly, the developed world share is at 53%. That's due to the slightly better performance, and to balance that out a bit, I've regularly bought a bit more emerging markets in the past. That's simply, in my view, my personal strategy to do a kind of rebalancing here. So how much emerging markets should you have? From my point of view, there are 3 interesting options, but of course the final decision is up to you. First, you can simply buy the Vanguard FTSE All World. This one invests purely based on market capitalization, so emerging markets make up only 10 or 12% of the ETF portfolio here. The US makes up 60%, and secondly, you can mix a developed world and an emerging markets fund however you like, 70-30, a common split as Finance Plus suggests. And this mixed ratio, many people don't know this. By the way, it comes from the early 2000s, around 2007, when emerging markets were performing significantly better than they are today. So it's not necessarily some sacred number that you always have to follow. Today, however, emerging markets account for around 40-45% of total global value creation, depending on the source, and this share is only going to increase. Unfortunately, many companies are still state-owned or not publicly listed, which is why I take the approach of buying more emerging markets than the 70-30 split in order to better reflect their actual share. You could go with a 60-40 split, for example, which roughly corresponds to the actual ratio based on economic output, but I go with a 50-50 split to essentially be about 5 years ahead, so to speak, because the share of emerging markets will only continue to grow. My thesis is that we'll also see more and more privatizations of state-owned enterprises here, and in my opinion, placing too much focus on the developed world, as is the case with the FTSE All-World, for example, is more like looking in the rearview mirror than looking toward the future of the global economy and where it's headed, but that's just my personal opinion. Over the past 10-14 years, developed world ETFs have performed significantly better, and I was wrong about that. But I hope that returns here will be significantly better over the next 10-14 years. From a fundamental perspective, I believe the chances for that are quite good, as mentioned at the beginning of the video. And even if that doesn't happen and we go sideways for another 5 years, fortunately, I also have other completely independent investments. Diversification is beautiful. I have my P2P loans where I've invested 67,000 euros, plus Bitcoin and stocks totaling 58,000 euros. So I'm not worried, I diversify and invest in everything. There will also be an update on my portfolio next week in the monthly portfolio update. Leave me a like and a subscription if you enjoyed it, and be sure to let me know in the comments below whether you're still investing in emerging markets or if you're now shifting into the Nasdaq. With that, I wish you good returns and see you next time.